Single-family homes and multifamily syndications. Both are real estate investing, but are very, very different from each other. In this video, I'm going to walk you through the differences between the two to help you decide which one is best for you. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about multifamily syndications versus single-family home investing. To start things off, let's really define what we are talking about. With multifamily syndications, we're really talking about commercial multifamily real estate. And for syndications typically, and we'll talk about what syndications actually are in a bit, but we're really dealing with larger apartment buildings. So let's say 50 units plus. With single family homes, we're talking with residential real estate, and this will become important later on. And when we talk about single family homes, we're talking about 1 unit houses, so basically a house. We can talk about duplexes, triplexes, fourplexes, anything that falls within that residential range of real estate. Typically, when you're talking with a lender, some lenders will deem anything under 6 units, sometimes under 7 units, as residential investing. Now, what are the similarities? Well, there is a big similarity in terms of the overall strategy. It's just how we apply it that becomes different. So whether it's a commercial multifamily property or a single family home property, how we make money remains the same. We take an underperforming asset, so let's say this is where the market is here. If we have our underperforming asset and it's not performing as well as we would like, maybe it's dated, maybe the rents are below market value, it needs renovation. If we can bring that property up to market value or improve it above the average standard market value, we are making money. We are making more money in terms of rents. Another buyer will offer us more money for the property because we've improved it. It's a lot better than it was before. It's the same whether we're dealing with an apartment building or with a house. Everybody watches HGTV and all the flipping shows. Well, with apartments, it's basically the same idea, but on a much larger scale. And of course, the time frame extends out because we're now renovating maybe 30 or 40 units rather than just a single house or a duplex. But like I said, overall, the strategy is the same. We're taking an underperforming asset, improving it, whether it's through operations, management, or physical value add, so doing renovations just to improve the property. And that is how we make money in real estate. The first thing to highlight is how the properties are valued. With a commercial multifamily property, the property is valued using what's called the income approach. And what I'll do is I'll put a link right up here to a video I did explaining how the income approach is used to value commercial real estate. It's all based on, like the name implies, the income the property produces. So you know how I was talking about how we make money in real estate investing by improving the asset and raising rents? Well, with a commercial property, especially an apartment building, if I can raise the rents, I'm going to be getting more money per every dollar that property produces because people, other investors, other buyers are willing to pay more for each dollar that property produces. So more cash flow means more money in my pocket as a seller. This is what we want to do. So whether it's improving rents through renovation, maybe it's improving our bottom line by optimizing expenses, putting utilities back on the tenants instead of us as the owner absorbing them. There are all sorts of strategies that we can use, but at the end of the day, it's all about improving what's called the NOI, net operating income. And like I said, watch that video and I'll explain everything there is to do with the income approach. Now, when we hop over to the residential side, with residential real estate, we use the comparable approach. And I did another video highlighting the comparable approach, and I'll put the link right up here so you can check it out. The issue we have with the comparable approach is it relies upon other properties in that neighborhood, comparable, similar properties, selling. And what we do is we compare the property that we have, do an apples to apples comparison. And so if 2 houses on the street sold for 400, then our property, if it's similar, is likely going to be valued at $400,000, regardless of the rent that it produces. So on the commercial side, everything is valued based on the income, the NOI the property produces, which is good because for us as investors, if we can improve that NOI, we are rewarded in terms of market value. On the residential side, we could be charging way more rent. Is the lender going to really care? Not really. The lender really cares about the comparable approach and comparing an apples to apples comparison, and they're going to be looking at what all the other houses are doing on the street. So that's a huge difference if you're wanting to control the valuation more and really be able to maximize the value of the property. The commercial side with multifamily really wins in this case. Then we have debt. It's an extremely important part of real estate. If you have bad debt, it can ruin a great deal, but you can actually make an average deal really great by having good debt. Let's start off with the commercial side. There are a lot of unique things about commercial debt that we don't really see on the residential side. We have interest-only periods where we don't have to pay the principal of the loan. We just have to pay the interest, which helps improve cash flow and makes more cash flow available to do the renovations that will actually make us the money that improves the NOI and in turn will raise the valuation of the property. So that extra cash flow is a really big deal if you're implementing a value add plan over a year and a half, 2 years. That cash flow can be really, really valuable for you. So those interest-only periods, those can be really important. And I'll put a link right up here to a video I did talking about commercial debt and interest-only payments when it comes to mortgages. And then we have non-recourse. And actually, before I explain this, I'll hop on over to the residential side, and then this will all make sense, or at least I hope it makes sense. So on the residential side, when it comes to debt, the lender looks at you to support the debt payments. You as the borrower comes first in terms of the lender's eyes. Your income, your resources have to be able to support the property's debt, and then the lender will, of course, look at the property second. But it doesn't really matter what the property is producing for rent because the lender cares about you. And if you do not pay your mortgage, if the renters stop and something happens, well, the lender will come after you and seize your assets. You are on the hook to make the lender whole again. That is called recourse. Now, non-recourse is the opposite, obviously, of recourse debt. But in the commercial real estate world, lenders don't really care about you as a borrower first. They want to make sure you are purchasing a property that can support itself, that is stabilized. Because what will happen is if you default on the loan, the lender will just take your asset, and those assets are very valuable. So they are able to offer non-recourse debt as opposed to recourse debt. So if you're looking at acquiring property, if you can acquire a commercial property and really take advantage of the interest-only periods in that mortgage, if you're able to structure it that way, and then also get non-recourse debt, so you're taking that load off your shoulders and placing it on the property, as opposed to the lender looking at you solely and you having to bear the burden, and in case things don't work out. There are several advantages to the commercial and multifamily side just through the nature of commercial financing. Now let's move to the holy grail of real estate, which is cash flow. When we're talking about residential properties, especially 1 and 2 unit properties, single family homes and duplexes, cash flow can be extremely tight, especially if you're in a hot real estate market. The rental yield just isn't there, and oftentimes people end up acquiring properties that are negatively geared, which means that they're actually making negative money every month. It can be incredibly challenging to scale your portfolio. So I'll just say hard to scale. And this is actually what I found when I was trying to get started in real estate investing. I started with single family homes and duplexes, and scaling was incredibly tough. One, because the lender was looking at you all the time to shoulder the burden and the risk of all those loans put together. But then also the cash flow is just really, really tough to get. And property management costs are a lot higher with residential houses. Sometimes they're 12%, sometimes you're 10%, but that gets very, very expensive. On the multifamily side, cash flow is a whole lot stronger, and this is what makes multifamily properties a lot more stable. CBRE did a study where they looked at all the types of commercial real estate, so retail, office, industrial, multifamily, and they found that in economic downturns and recessions, multifamily perform the best, and cash flow is one of the reasons why. When you have 100 units, let's say, or even 75 or 50 units, we have something called the economies of scale, which means the expense ratio is spread out over many more units, and that allows us to collect more cash flow and improves our NOI. Instead of having a property manager manage a single house, now we're having that same property manager manage 100 units. Obviously, the cost per unit for that management goes down. The cost of insurance goes down per unit when we're in this situation as opposed to a fourplex or a triplex or a duplex. And property management fees can be 3%. They can be 2%. They can be 4%. And with these larger properties, we have on-site staff, so full-time management, groundskeeping, repairman, leasing staff. I'm not sure if I even said the leasing staff already, but the property supports its full-time staff as opposed to a single-family portfolio or even a single-family home on its own, where you might have a property manager managing 50 other properties. Is a property manager on-site every day? No. So could you argue that a full-time staff looking after that specific property, will that property be better run? Potentially. There's a good argument for that. Will problems be nipped in the bud a whole lot sooner, saving you money? Potentially, there's a good argument for that. So when it comes to cash flow is especially important when we hit choppy markets, when you're actually holding tight, battening down the hatches. As long as you have good cash flow and the market's tanking around you, you can hold that property indefinitely as long as you have the right type of debt on the property. And I've talked about that in many videos before. So if you have questions about what type of debt to put on these properties, just check out the playlist, and I've got a whole bunch of videos for you. Now let's talk about how you can actually invest in these properties and these opportunities. Let's say right now you are a high net worth individual, and you have $100,000 to invest or $200,000 to invest. Where is your money going to go? Is it going to go to the multifamily side here on the commercial real estate or the residential side? Well, that's a really good question, and I can't make that determination for you, but I just want to highlight a couple things to keep in mind. First of all, let's talk about how we actually invest in these vehicles. Well, with residential real estate, oftentimes with a single family home, duplex, triplex, that sort of thing, you will invest if you don't have the real estate experience, but you're bringing capital to the equation. You're going to enter in to what's called a JV or a joint venture. And this is really a partnership. And that J looks like a backwards D. There we go. JV. So you're going to enter into a JV, which is commonly set up like this. So 50% of the JV is going to go towards you who's bringing the capital. And then 50% is going to go towards the active member managing the deal. And this is a person with the real estate experience. You're bringing the capital and you're partners together in this property. This is not passive investing. A lot of people make the mistake of claiming that this is passive investing. Oh, Mr. and Mrs. Investor, you're bringing the money, I'll do all the work. But in the eyes of the law, you are just as active as that manager. So if something goes wrong in the deal, you are on the hook. It doesn't matter, who's active, managing, dealing with the tenants every day. In this type of structure, you are an active participant. So if the deal goes south, you have to keep that in mind. This is not passive investing. It is active in all cases. With multifamily, we have something called the syndication. And I am running out of whiteboard space. All right, so in the syndication, what it means is we have active and passive, but it's actually true passive investing. So we have somebody called the GP, and I'll put a link right up here to a video I did explaining all about a syndication in much more detail. This is just going to be a bird's eye level. So we have the general partners, which are active, then we have limited partners, which are the LPs. Now, the way this is structured and how the laws are structured and laid out, if you're bringing capital as an LP, so if you're just investing money, you are afforded many protections under the law because you are limited in what you're bringing. You're placing your capital at risk in the market, just like you would with stocks, with a single family home. You're risking your capital in exchange for the potential of a return. The GP, the general partners, the real estate experts in this case, they are the ones shouldering all the risk. So with the multifamily syndication, you get all the benefits, the cash flow economies of scale, all the benefits of the debt, how the properties are valued, etc. All this is working for you. Plus, you actually get true passive investing. So you're doing what you do best on a day-to-day basis as an investor, whether you're a doctor, accountant, lawyer, programmer, business owner. I could list 50 different things at this point. But if you're earning that high income, putting bread on the table, doing what you do best, and you want to make your money work hard for you in a real estate deal, well, you are truly passive in this case. Plus, with the scale of multifamily, we have something called depreciation, and I will save that for another video. And I've already done videos on depreciation, but basically what happens is you get all these tax credits that the government gives you just because you're buying into a larger property, and you're able to do a whole bunch of work on the accounting side through cost segregation to really save when it comes to tax time. So this is why a lot of investors enjoy investing in real estate, and especially multifamily commercial real estate. Not only is their money earning a strong return, they're getting a lot of cash flow, but they're also not paying a whole lot of tax, which is half the battle. It's what you keep in your pocket, not what you just get in your check. So the whiteboard got extremely messy. I tried covering a whole lot of stuff, but not going too deep. So this should give you a pretty good idea of the pros and cons of multifamily versus single family homes. It's just a different setup in terms of how the properties are valued, the type of debt we can get, the cash flow situation, how economies of scale work in our favor or against us. If you're just getting started looking at your different options, this will give you a good starting point. And like I said, I have many other videos for you to take a look at. If you're interested in multifamily real estate, check out the link down below for our free Facebook group. You can join for free, and it's all about people interested in building wealth through multifamily real estate. And if you are an accredited investor interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.